This is Taking Stock on Bloomberg. I'm Pim Fox. Now we turn our attention to the world of private equity. By its very nature, it can be secretive, it can be selective, but new regulations are intent on making private equity investing more transparent and perhaps less risky. Does it mean the end of an era of private equity as a high-return investment vehicle? Well, let's figure this out. Let's bring in our experts. Coming to us from Washington, we have the former head of U.S. and international private equity at AIG. We have Larry Mellinger. And joining me here in New York, we have, well, he's run a fund of funds buying whole portfolios in return for instant liquidity, the president of Coller Capital, Frank Morgan, and the global chair of private equity at the New York law firm of Dewey and LeBoeuf, Joe Smith. Gentlemen, welcome.
Thank you so much.
Thank you.
Frank, let me begin by coming to you as someone that's running Coller Capital and dealing with investors. Is there any concern as to these new regulations that may be passed in Washington? Are you getting any idea that they are less interested in investing in private equity because of the government's new role?
I'm not sure I'd say it's directly related to the government's new role. That is a concern. But investors that we have queried have problems with private equity. They think that in our latest survey, 25% of general partners will not be able to raise a new fund. 10% of limited partners in the survey will default on their investment. So there's a different sense about private equity going forward.
And is this because of a confluence of events having to do not just with government intervention, but more about what's going on in the marketplace?
It's the marketplace. You know, if you look at how much money was raised in private equity last year, it's about 10 times what was raised 10 years ago. So there's been a burgeoning inflow of money into this industry. A lot of people have expected much better returns. This turn has caused them to think again, and there are issues in the industry.
Larry Mellinger, let me come to you. Have you seen the same kind of pushback from investors? Are they generating more questions and saying less cash might be available for private equity?
No doubt there's some degree of pushback, but let's look at the bigger picture. And at the beginning of July, there was something like $400 to $450 billion in what we call dry powder that was previously raised and legally committed to the private equity space. That is approximately equivalent to every private equity deal that was done between 2004, 5, and 6. There's a lot of money out there. It's not being deployed real rapidly because of economic uncertainty at the moment, other issues about what direction the interest rates will go in and what's going to happen in taxes and what's going to happen in regulation. So there's a lot of money to be deployed, and it depends on the pace of economic pickup. That funding could last for a year or two yet, and therefore buy us time to get GPs and LPs together and find a common space where they can continue to work together to raise more capital.
Joe Smith, let me ask you, as someone that is focused on the legal aspects of investing in private equity, are you getting investors who come to you and say, you know, can you figure out a way I want to get out of this investment? I don't want to do this anymore.
Many of our clients are looking for liquidity and are interested in selling to secondaries funds similar to Coller Capital. That having been said, many of our clients are eager to invest in secondaries funds and see this as an ideal time to get in and do some bottom fishing. So while I do think that there is a lot of uncertainty in the market, and I do think that people are not at all sanguine about economic conditions, fundraising is very hard and deal doing is very hard, there's still smart money out there, and there's still a substantial pool of capital waiting to be deployed at the right time.
All right, we're going to talk about some of that capital and where it might be deployed, more on the health of the private equity industry and the outlook for profits. Also, we'll take a look at whether investing in investment companies is a good idea for investors. And a programming note, Bloomberg's Taking Stock begins each weekday at 3 p.m. Eastern on Bloomberg, 1130 a.m. This is Taking Stock on Bloomberg. I'm Pim Fox. We're talking about the world of private equity. We have Larry Mellinger, Managing Director of LKM Advisors, joining us from Washington. Also, we have Joseph Smith. He is the partner and the head of the private equity practice at Dewey and LeBoeuf, and Frank Morgan, the president of Coller Capital. Frank, you know, we were talking off camera about sort of the fractured world of private equity, because it's not really wise to talk about it as a homogenous. Where is some of this $400 to $50 billion on the sidelines? Is it Is it accessible for people in private equity right now?
Well, some of it is within private equity funds at the moment who are calling capital over time and making investments. We've seen the result, or the opposite, of global warming. We've had a ice cube in private equity in the past quarter. People are not calling money. They're not making investments. They're taking their time. They're tending to their existing portfolios. In terms of investors who have money that want to come into private equity, I think they're looking askance at some of the large buyout funds, the economics that are there and so forth, and saying, gee, maybe we should go into a secondary fund, a distress fund, maybe some infrastructure, but some type of investment that could do better for them than they think buyout funds might do at this time.
Joe Smith, as someone that represents investors or potential investors, how has your position, your power at the table changed when you're negotiating to bring someone into a private equity?
Well, I think this is a good time to be a limited partner if you have capital to invest. I was speaking at a private equity conference recently, and the question came up, how have terms and conditions changed? And somebody, not me, somebody leaned into the microphone and said, I have no idea how terms and conditions have changed because I haven't seen an offering memorandum since the Lehman bankruptcy. I beg to differ. I've actually seen quite a few. And while there are no seismic shifts, I think that limited partners have much more power than they had in the past to ask for key man provisions, no-fault divorce provisions, sharing of transaction fees, and I think that there's some slight downward pressure on management fees. That having been said, there's also a flight to quality going on, and terms and conditions will not change that much because only the most successful GPs will, in fact, be able to raise their funds, and that will tend to normalize terms and conditions back to where they'd been historically.
Larry Mellinger, is this what you're finding, and are there any specific sectors that you see as being perhaps the most coveted on the part of private equity investors?
I think so. Look, for those that enjoy some of the money that we're talking about that's sitting on the sidelines, some of that $450 billion, and for other limited partners that we can say are late to the party or under-allocated, I think there's tremendous opportunities out there. I'd mention 4 or 5 sectors. First of all, emerging markets. Compared to where we were in emerging markets 20 or 30 years ago, and I've been doing emerging markets, cross-border finance for my entire career, I think major gains and strides have been taken to increase transparency, economic stability, deeper capital markets, private property protections, and others. So I think the BRIC countries that you often hear about, the major other emerging market countries, the so-called Eastern European countries, even in Japan and, say, Korea, Taiwan, there's major opportunities out there. These countries are reforming, they're growing, they have tremendous expanding middle classes. So I like the emerging market opportunities. I think, as was just mentioned, distressed funds, secondaries are logical ones. Certainly other niche funds, infrastructure, some energy, healthcare. When you look at the global stage, I think there's going to continue to be tremendous demand to make money. And we saw this back in 01 and 02 during the aftermath of 9/11 and the dot-com bubble bursting. There was a lot of doom and gloom, and those private equity firms that were early in at low valuations made an enormous amount of money. And oh, by the way, they were also the ones that had the greatest success at fundraising in subsequent years right after that.
Frank Morgan, if we see an uptick in initial public offerings, if we see more M&A activity, are we going to come back in 6 months and it'll be a whole new ballgame for private equity?
I'm not sure it'll be a whole new ballgame, but that will help a lot. I think the problem with private equity at the moment, one of them is the exit market is totally closed. Little M&A activity, little leverage available for deals, no IPO market to speak of, and venture funds certainly depend on that, and buyout funds want to do trade sales. They can't do private equity to private equity club deals any longer. So that would help a great deal. But I think, you know, what's going to happen if we have 25% of private equity funds going out of business, which is what our survey says, are we going to have, as Joe Smith suggests, a sea change in terms of terms and leverage with limited partners? Are they going to get together and act in a unified manner and really change the landscape of private equity? I think that remains to be seen. All
right. I want to thank you all, gentlemen. Thank you very much. Frank Morgan coming in from Coller Capital, Joe Smith from Dewey and LeBoeuf, and we have Larry Mellinger coming to us from LKM. We're coming right back.